Hello and welcome to Dialogue. I'm Yang Rui in Beijing. Recently, more and more China's rich people are planning to increase their overseas assets, especially property. Why are overseas investments becoming so popular? Following the rise of domestic real estate prices and the devaluation of the RMB, is the outflow of capital still controllable in China? And how will China adjust its financial policy to stabilize domestic investment and its economic development? To discuss these questions and more, I am joined in the studio by Professor Liu Baocheng from the University of International Business and Economics and Charles Liu, founder and CEO of How Capital. But before we get started, let's take a quick look at this.
From the Waldorf Hotel in New York to the landmark building in Madrid, and from the media rights of the English Premier League to the transfer of talented football players, Chinese money is flooding overseas to buy valuable assets in almost every realm. According to the Ministry of Commerce, excluding financial investment, $118 billion was poured into foreign markets by Chinese firms last year. That's a near 15% growth. But along with the booming overseas investments, concerns surrounding China's large-scale capital outflow are also rising, especially when private capitalists like Hong Kong real estate tycoon Li Ka-shing are selling their properties in the mainland. The assumption seems to be also proven by the rapid shrink in foreign exchange reserves. From June 2014 to January 2016, China's forex reserves declined by about $760 billion to $3.2 trillion. But the concerns, according to Gao Husheng, China's Minister of Commerce, are unfounded.
Firstly, I don't agree with that there is a large-scale departure of foreign investment. This is not the case. If foreign investment does depart from China, then two sets of numbers would show problems. The amount of foreign investment which was introduced earlier would drop, but our level of foreign investment actually increased in 2014 and 2015. Also, the changes of the inner structure were significant.
Moreover, Gao said China's ability to absorb overseas investment remained strong as well, attracting some $120 billion of foreign investment, an increase of more than 5%. China has remained the #1 destination for foreign investment among all the emerging markets. China's share of global trade in 2016 is expected to rise by 1 basis point from 12.2%, exceeding 13%, the fastest growth ever.
Now, gentlemen, why do so many Chinese from the mainland opt for buying properties and making overseas investment? What's behind the current craze? Charles?
I think it's a much bigger picture. The real issue is that China really doesn't have many channels for investment. Domestic investment, what do you have? Real estate and the stock market. If both don't do too well or both are in bubble territory, you look for opportunities to diversify your portfolio or your holdings. I think what this is also a reflection, an important reflection of the amount of wealth that's being accumulated by the Chinese population and the rising middle class. 30 years ago, you wouldn't have many people with the capacity to make such investments abroad.
Do you believe this is a serious attempt by most of those super rich guys in China to diversify their channels of investment?
Yeah, I think the one motivation is to spread their risk, because they receive a lot of advice now from even specialized consulting firms to spread the risk by diversified investment. And the other is also family consideration, and they consider immigration or to send their kids to stay overseas while studying in foreign universities. And third, I think it's also looking for return on investment, because they do not really see, given all the policy pressures over the real estate development in China, and so many people, they are used to play over the real estate at home, and now they do not find ample opportunities, so they switch to overseas. So the other consideration is that, okay, while they are investing on a corporate basis into certain projects, so near the projects, normally they buy homes and even buy recreation parks, so seeing the big price gap between the real estate, say in China and overseas, for example in Australia or in the United States.
mainlanders are traveling abroad in their millions.
100
Every
million.
month, hundreds of millions are traveling abroad. Now, many of the package tours are actually propelled and motivated by things like taking a look at the properties in Europe and the other side of the Pacific Ocean. Now, why do you think there's such a boom of property purchase?
Well, I think Dr. Liu has basically addressed it. There are those who are looking at immigrating abroad. They're looking at getting apartments for their kids. But ultimately when you have a lot of wealth and you don't get your return in China, you look for other ways of getting a return. I think it's capital flow always that way.
And the mortgage rate is
much
low.
lower, sure.
Much
But
lower in the
I would
United
say this is not a major issue. Chinese buying homes abroad, maybe 10 billion, maybe $8 billion. The real movement, when we talk about capital flows, is actually much more substantial. We're actually looking at, for example, in the first 2 months of this year, already announced outbound acquisitions of over $100 billion. So those are another type of capital flow. But would you call it capital flight? I wouldn't call it capital flight. No, there's a lot of that going on as well.
But do you think the range of outbound capital flight is controllable? Sure, along with the outbound flight comes the risks, if not systematic risks for this country.
Well, I would put it this way. The world is now interconnected and is a global pool of capital. People move capital to seek return. When the US was printing money with its QE, very, very cheap money can be had, and a lot of hot money in one way or another entered into China because, number one, RMB appreciation, locked up. You know that you're getting an appreciation. Number two, the interest rates are much higher in China. So you move through whichever channel you can find into China.
True. In previous years, we focused on investment-driven growth, and much of the overseas investment must assume the form of foreign direct investment.
Right. That's right. Because if you can't get a yield outside, you try to find in China. If you can't get a yield in China, you find it maybe someplace else.
Now, given the phasing out of quantitative easing policy of the Federal Reserve, as well as the attempt by more and more middle-income families, as well as super-rich guys in the mainland to diversify their investment channels, as Charles put it earlier, what do you think of the importance, the growing importance of controlling the capital flow? I mean, otherwise, don't you think we're going to run the risk of RMB devaluation?
Well, actually, the picture is not as so much a cause for panic because if you do the basic math, for example, now we had a surplus of nearly 500 billion US dollars. We also had an inflow last year over 100 billion foreign direct investment, and the total estimation for the outflow was 550 billion US dollars. So that's almost equalized the landscape. So, but of course, the issue lies in the confidence over the Chinese economic performance as a larger picture, and also the continued devaluation of RMB, given also the interest hike of the United States. But I think this panic is over because the U.S. has no good reason to continuously to raise their interest rate. And also
there's
China.
a rumor that the Federal Reserve is seriously studying the possibility of a negative interest rate.
Yeah.
What do you think of this?
Yeah, I think now they cannot afford to play against the whole global currency at the moment because every currency, and if you look at South Korea and even Japan, so their depreciation rate is even further than the RMB. So therefore, they are now fighting a financial war against the rest of the world, which is really no winner at the end. So therefore, they have to adjust to their interest policy.
I would even go further. I would say that the U.S. economy is really in a contraction mode. I've been saying this for 6 months. And look at what happened to the PMI numbers in the service sector yesterday announced. Projected was 53.5 by the economists, and it was 53.8, I think, last month. It came out to be 49.8, which is contraction. And this is for the service sector in the U.S., which is a major driving force for the entire U.S. economy.
Service industry accounts for at least 75 or if not 80% of the U.S.
That's right.
economy.
And it's contraction time. It's contraction time. Whatever reason they give, oh, it was a really cold month. The weather was bad. But I mean, there's no question that the overall global economy is contracting, and China is actually doing quite well.
On the other hand, President Obama and his team are sparing no efforts to reindustrialize the U.S. economy in the hope of stemming the flow of outsourcing their jobs, if not by the Chinese joint ventures, at least by other low-income economies on the periphery of China. What do you think of this?
Unfortunately, they do not have many SOEs as we have in China, so they don't listen to the government call. And so the investors, the owners of the companies, they follow what the market can offer. And the U.S. industry has hollowed out for so many years, and you cannot even expect people in Carolina to continue to do the carpentry, people in Cleveland to do the steel making anymore. So it is easier said politically, but as a business decision, the production cycle will have to continue to move to the low labor cost area, to the low environmental requirement. So right now, China is now in the middle. So even China, we see that both foreign investment and Chinese investment at home now are shifting more to the lowland area like Vietnam and Thailand. So why a reverse trend? So right now, for the U.S. solution is that, okay, they continue to invest more into the high-end R&D, and possibly they have breakthrough in the IT and the biotechnology. But right now, we can only see the hope at the end of the tunnel. They are not translated into productivity and commercializability yet.
There are two other aspects to this. In addition to the fact that you don't have the labor force for manufacturing in the U.S. anymore after 2 decades. Manufacturing requires infrastructure for manufacturing. In other words, you have a value chain. Now, U.S. is a consumption economy. To rebuild the whole manufacturing value chain or production chain, the infrastructure is going to take decades and a lot of money. And this is why, for example, India can't catch up. You don't have the infrastructure for manufacturing. Second, market. China is a bigger market than anywhere else.
Since the end of the year 2014, Charles and Baocheng, the Central Bank of China has cut interest rates 6 times, and with the aim of destocking, the cost of purchasing houses and development loans have continued to reduce. How have these measures worked to increase the domestic investment? I mean, obviously, this is a part of the some of the measures being rolled out to stem the flow of or outflow of capital.
Well, you get a cold, and then you overdose with more penicillin. So that solved the problem temporarily, but in the meantime, it continued to add to the excessive capacity because much of the money was channeled to the either to play for the money game on the stock exchange, or channeled to the excessive capacity run by state-owned firms. But all those entrepreneurs, innovation firms run on the private market, they had little access to this type of money. So we used to call on politically to have a targeted easing. So to support the Chinese agricultural industry, to support the high-tech research, but unfortunately the money was not really channeled this way. So there is a increasing danger. I can be a little, say, politically incorrect. Is that we are beefing up the zombie Chinese enterprise while we are still pointing the fingers to them to solve the problem on them. So this is really a very contradictory policy that I can possibly see.
Thank you very much, Charles and Baocheng. We are discussing why increasingly so many Chinese from the mainland start to diversify their asset management outside this country. We'll be back in a short while. Stay with us. Welcome back, gentlemen. According to the 2015 China Mass Affluent White Paper, which was published by Forbes, China's mass affluent class could jump to 15.28 million, and private investable funds might exceed 114 trillion RMB by the end of 2015. Therefore, the affluent middle class as well as the super rich guys in China have good reasons to justify their diversification of the overseas asset management. And we have actually spent some time discussing why they have made such options, and increasingly so. Now, next question, Charles. In the first month of January, China's newly increased loans reached 2.5 trillion RMB. 20% of them are going to the real estate market. Facing the increasing capital outflow, is China's credit easing policy strong enough to stabilize the domestic investment?
I don't think that is really the focus of the government in terms of stabilizing or increasing domestic investments or restoring. I think the real focus has been a transformation. The changing and the getting rid of the excess capacity, or moving some of the excess capacity abroad through the One Belt, One Road policy, and so on. The loosening up per se is not the objective. I think the objective is much more a transformation of the economy. But I'd like to go back to what you had addressed a little while ago, the massive wealth accumulated by the Chinese middle class. And it is really, really dangerous if you don't have sophisticated methods or channels of investment for that massive wealth to create asset bubbles. So I would actually see it's a good thing that their ability to diversify into global investments is taking some pressure valve off the possibility of creating asset bubbles. If it is all kept here, where is it going to go?
Are you suggesting actually in the understatement that due to those proactive efforts by the middle class guys who are affluent, according to the survey of Forbes, and the rich guys, they are actually assisting the Chinese government in avoiding a possible financial crisis? In fact, some of the guys in the West are crying foul about the prospects of Chinese economy, given the downward pressure, which is increasing.
Yeah, I would say it's very important, because if more and more Chinese become more sophisticated as an investor, it's good for the Chinese economy. If the pressure valve is released so that you don't have much more bubbles created in the real estate market or the stock market, that's also a good thing. So there are some positive aspects to this diversification of their portfolios.
Now, in the year 2009, Professor Liu Baocheng, losing credit in the first half of the year led to the credit crunch, ironically, in the second half of the year. How do you view the potential risks of the credit policy this year?
Well, as I said, we overdosed the problem in 2009, and was the massive stimulus package. So I was overjoyed to see that from 2 years ago we gradually had the targeted easing to support the three identified the areas. But right now, the management is not very exciting, because the policy objective really didn't realize from its original intent. So right now, if we can see that the central government has offset the debt by with the local governments. The local government feels pretty much relieved. I really anticipate another forensic infrastructure building administered by the localities. So this is really a dangerous sign. The other is the state-owned firms. It seems that the reform was much more of a hype. Yes, the anti-corruption really disciplined these decision makers, but the job scale and the decision to invest is not really following what has been expected for innovation. So therefore, more of those quantitative easing over rampant support won't really help the situation. It can only create asset bubble, both at home and overseas, and also to enlarge the wealth gap between different institutional and also individuals.
A closer look at the dynamics in the process of internationalizing RMB, you quickly discover that the Chinese authorities have started the process of liberalizing the exchange rate to broaden our access to foreign financial services and, of course, to open our capital account, as we have talked about for years. Now, how could the globalization of RMB impact on China's overseas investment? Charles.
I think globalization of RMB has many ramifications. But it's going to be
SDR issue is, of course, one of the latest.
But it's going to be a very long process. It's really going to take some time before it reaches quote-unquote globalization.
Are you surprised that one senior observer who followed the process of AIIB said recently in one of his articles that it's good for the Chinese authorities not to opt for the use of RMB, instead of they will continue using US dollars for the infrastructure investment? What do you make of his?
Well, I think the RMB is still not a global investment currency.
No,
so
not yet.
Not yet, and it will be some time. It'll be quite some time. The Chinese economy overall, especially the financial system, I fear, is still not mature enough to withstand the fluctuations in global capital markets that is done trillions of dollars in an instant. And there has to be still some level of protection. The Great Wall of China may come down a little bit, but it will not come down completely. Because, as I was saying before, it's one global pool of capital. When there is a yield in China, everything comes in. When there is less of a yield, everything goes out. So you can't really allow that to happen, because the destructive force for economy as elaborated and as large as China's is very difficult to manage.
Guys, whether we're going to have a yield or not from the Chinese market largely depends also on a matter of confidence. Confidence of consumers, confidence of investment, confidence of the government, confidence of our partners. You can name it. So I could still remember former Premier Wen Jiabao said right after the outbreak of the financial crisis in the year 2008 that confidence is as expensive or even more expensive than gold. He was quoted as saying so. Do you think this still matters?
Well, confidence is good, but confidence must rest upon the substance and rational calculation of the reality. For overseas investment, both for the policymakers, institutional investors, and individual investors, I see that they have not reached the sophistication level as we can compare with the Western world. And well, there's nothing to blame on them. And Japanese burned their hands. They bought Rockefeller Center, and then they lost a big deal, and they sold back to the native people. So China is somewhat repeating the same pace. So yes,
excuse me, are you saying that we're buying actually some of the toxic assets?
We bought a lot, and also with poor management to follow, many of those good assets may turn out to be toxic per se. So now, if we can do a telework of what is really the return for the Chinese overseas investment, so what is really the return for many of those assets? So I should say only 1/5 of them are really generating certain margin, but the rest are still burning the money. So
they are burning money. For example, we have just purchased a landmark building in downtown Madrid, Spain, and to the biggest surprise of the guy who acquired this piece of property there, he was told not to do any decoration. When the Chinese property developer decides to buy a major property, it means he or she will do whatever they like about in terms of decoration, for example. But he was not allowed to do that. That illustrates the cultural clashes, perhaps, and it also showcases perhaps his poor knowledge about the legal studies. He should have employed a lawyer from this country, the host country, to do more homework.
Yeah, I think that's a very important point. Who is doing the buying? And there are many different of entities and people doing the buying. Those who buy an apartment in Palo Alto because his son or daughter is going to Stanford, that's one type of buying. Those who buy something in Toronto or in Vancouver because they're immigrating to Canada, that's another type of buying. Now, for example, a major Chinese entity bought a chain of movie theaters in the US. That's a very known deal. And that actually ended up to be quite good in investment. The major SOE going out to buy natural resources, if they bought energy resources, they're in big trouble because they paid very high prices in 2009, 2010, when the prices were indeed ridiculous. For example, at that time, a million BTU of LNG was going for about $18, and now landed in China is about $6.5.
Now, gentlemen, we've been discussing outflow of the capital based on the assumption somehow that those prospective investors have basically given up their hope for the domestic market or opportunities in the domestic market. Let's take the stock market as an example. Government's intervention was said to have failed, and in a devastating way. Does it mean that after licking the wounds for quite a few months and quite a few months of meditation, the Chinese authorities could somehow relax the grip on the stock market, attracting the Chinese investment back? Because the Chinese concept for the IPO in the United States may have failed due to the disillusionment. Well, very quickly.
Yeah, very quickly. I think you again have to make a very clear differentiation between different people and their investment strategies and different entities. Is it state-owned? Is not state-owned? If it's financial investor or is it institutional investor? I mean, there's just many different types. And the Chinese are learning very quickly. I think it's very diversified now.
Thank you very much. With that, we come to the end of this edition on how to improve our asset management outside China. I'm not talking about that they have given up the domestic market here, but I'll see you next time. Goodbye.